Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is twofold. It's MS 251, and according to the new curriculum, the course code for this subject is BS 251 with same course contents. This is our lecture number 19, and the topic for today's discussion is classification of working capital and as well as the working capital management. The outline of this lecture consists of 5 main agenda points. Number first is classification of working capital on the basis of component and time. That is, we are going to classify the working capital. As in my previous lecture, I have already explained what is working capital and what is net working capital. So for discussion and understanding the working capital concept, you can listen to my previous lecture. However, in this lecture, the emphasis will be on the discussion related with its component, like what are the components of working capital. That is, cash, account receivable, and inventory are the main component of the working capital or current assets. And secondly, we are going to classify our working capital, which is the current level of assets in our organization, according to its permanent or temporary nature. And this discussion related with permanent or temporary comes under the umbrella of classification with respect to time. We'll discuss spontaneous financing. It's a very important concept that helps the company to manage its working capital. Thirdly, we are going to discuss the hedging approach in this lecture. The other name for this hedging approach is maturity matching principle. That is to finance the current level of asset according to the maturity level of that asset in the organization. If the maturity of the asset is short term, then we are going to finance that asset with short term financing strategies. However, if the maturity is greater than for 1 year of time period, like for fixed assets or fixed nature of the current assets, we are going to finance that asset with long-term financing strategy. Fourthly, we'll discuss the conservative approach for working capital management. And at the conclusion or at the end of this lecture, the discussion will be related to aggressive approach of working capital management. So let's discuss one by one these agendas in detail. The classification of working capital consists of with respect to components. By components, we can divide or classify working capital on the basis of cash, marketable securities, receivables, and the inventory. If you notice, these 4 different titles belong to the balance sheet of the company, and specifically if we write them in order of liquidity, then cash needs to be written first, then the marketable security, which is also a current asset. When a company invests its idle funds into the securities or shares of another company, that investment is known as marketable securities investment. As we know that the holder of marketable security can sell out its share anytime without getting delay. So therefore this asset can be transformed or transferred into cash at the market price and very fastly as well. Receivables are the company's account receivable current asset, and similarly the inventory could be in raw form and as well as in the form of finished goods. So we can say that in principle these four titles belong to the current assets of the company, and we can infer that these four accounts or current assets management is known as working capital management. Now let's discuss with respect to time how can we classify working capital or different titles of accounts which consist of working capital. So we can divide or classify on the basis of time as well, and by time we mean either the current assets may be permanent in nature or they could be temporary in nature. By permanent we mean that certain kinds of or certain level of the current assets which are cash, marketable securities, receivable and inventory will be available in the balance sheet all the time during an accounting period or a specific time period. So normally company has certain level of cash all the time available in its treasury or in the bank account. Similarly, the company might have certain investment in marketable securities, and definitely for sure there are credit sales, so the receivables are present all the time on the balance sheet. And similarly there could be certain level of inventory which must be present all the time in the company. So when certain level of these assets are available in the company's balance sheet, that portion of current asset is known as permanent current asset. We have a temporary level of current assets. Let's suppose if a business is involved in a seasonal kind of business operations, then in the summer it will require an extra amount of inventory. Like for example, the business nature is to manufacture ice cream, then the ice cream and cold drinks demand will increase in the summer season, which requires the company to increase its inventory level in those peak days with seasonal financing. And when the season over, the level of that current assets in the inventory needs to be reduced so that there must be no extra charges or costs to be borne by the company. So here is the two methods of classification of working capital with respect to the components comprising of different current assets and the time factor, which could be permanent current asset and the temporary current assets. These will further be elaborated in graphs and graphical methods in the next slide. So we have first of all the permanent working capital. Let's take the amount of current assets required to meet a firm's long-term minimum needs is known as permanent working capital or permanent current assets. Here is a diagram representing the dollar amount of the current assets, and on the horizontal axis there is a time limit when the current assets are required for a longer period of time. In that case, the current assets become permanent in nature. And here is an example that let's suppose there could be a higher level of current assets required at any specific period of time. However, out of that current assets, let me select the pen. Like for example, this is the level of current assets required at the moment at time t1. So out of this total level of current assets, this portion where there is an intersection, so up to there we are in need of permanent current assets, and above that there could be a season for that specific current assets which will drop down later on when the season will get over. Similarly, we have a temporary working capital nature, that is the amount of current asset that varies with the seasonal requirements. Like this red line shows the permanent level of current asset required all the time to be available in the company. However, the seasonal demand, let's suppose the summer has been started and there was an increase in the demand of soft drinks or ice cream. So the company will require to increase its current level of assets from its fixed portion or permanent portion of current assets to meet the seasonal demand of the product. So when there is an increase in the temporary current assets, such kind of assets are known as seasonal assets requirement or seasonal inventory. And with the passage of time, when the season will get over, the demand for excess inventory will get reduced. And now the another season, maybe the winter is getting started. So if the business nature is of apparel or clothes, then in winter sweater jackets demand has been increased. So in order to meet that seasonal requirement in the inventory, to increase the number of sweaters and jackets to be available in the departmental store, the inventory level needs to be increased with temporary current assets. And similarly, the season will get off and that the requirement for increase in the inventory will reduce. And then the next season may start. So similarly, to and fro, this seasonal demand of current assets may be increasing and decreasing depending upon the level of demands in the market according to the season. Let's discuss the financing current asset. We can finance our current assets, which are cash, account receivable, and inventory. In particular, we have two options: either to go for short-term financing or to go with long-term financing, or the third chance is to have a mix of short-term and long-term financing in order to have the working capital management in the organization. Let's discuss a very important concept over here, which is spontaneous financing. It really helps to do the working capital management in the company. By spontaneous financing, we mean all those financing are methods of generating funds which automatically arises in the normal course of operation of the business. For example, we have trade credits. By trade credits, we mean accounts payable. When a company purchases its raw material from the supplier, then automatically it requires, or the supplier requires the company to pay out their obligation within 30 days, 60 days, or whatever the deal is between the supplier and the company. So such kind of time period available to pay the inventory cost is known as trade credit or a spontaneous financing. And other payable and accruals may also be included, like let's suppose the company has deferred its tax payment for the next month or for the next 2-3 months, and similarly accruals, any kind of expense that has been incurred but not yet paid by the company, like utility bills are due, but we got certain number of days to pay out those expenses, like utility expenses. So the number of days or time period the company is allowed to pay out its obligation is known as the lead time period. And in this time period, company can utilize its cash for any other purposes. So such kind of financing or fundraising or fund generation which automatically occurs in the organization is known as spontaneous financing, and these occur in the firm's day-to-day operation. However, our emphasis is on the discussion related with managing the non-spontaneous financing of assets, because the spontaneous financing cannot cover up the demands and requirements of the business. So therefore, non-spontaneous financing mechanism is required, which is short-term financing or long-term financing, to have our working capital managed. Here comes the first technique to manage the working capital for the organization or the company, which is known as the hedging method. By hedging, we mean the second name for hedging approach for working capital management is known as maturity matching. As the name explains, we have to match up the maturity of the asset with the financing technique. Like, let's suppose we are going to finance the fixed asset which will last for number of years in the company. So we have to finance it with long-term financing technique rather than to be financed with short-term financing. When we are talking about short-term and long-term financing, we mean that the short-term financing mean any amount borrowed from bank and any other depository institution shall be returned back within 1 year of time period, and when the loan amount borrowed from any depository institution or any depository banking organization which requires the body or company to pay out its principal along with the interest beyond the 1 year of time period, like for 2 years, 3 years, or 5 years of loan, is considered as long-term financing. So the hedging or maturity principle requires the company to finance the fixed asset. Fixed assets are those assets which last for more than 1 year of time period in the company, and they are usually used for revenue generation in the company. So such kind of asset must be financed with long-term financing of 5 years, 6 years, or whatever the time period it is, but it must be for greater than 1 year. So the hedging or maturity approach tells us a method of financing where each asset would be offset with the financing instrument of same approximate maturity. So we know that the current assets are normally converted into cash within 1 year of time period. So therefore we will go for short-term financing in order to purchase the current assets. And for the purchasing or buying or managing the fixed asset, we have to go with the long-term financing. Let's discuss the graph in detail. Here is the total amount of assets and the time period required. We can see that the blue line is depicting the number of fixed assets over the period of time. And we have seen that the fixed asset of the companies are financed by the long-term financing techniques, which is a loan which maturity is more than for 1 year of time period. And we have seen there are current assets need, and this red line shows the permanent nature of current asset. Although this level belongs to the current asset, but this straight line shows the permanent nature of current asset which will last in the company over the period of time. So in order to have the hedging or maturity principle, the company should finance its not only fixed asset but as well as the fixed nature of current asset with long-term financing, because the maturity of these current asset is similar to those of fixed asset, and this permanent nature of current asset lost or remains in the company for a longer period of time. However, we can see that this green diagram or green graph is showing the jumps and drops over the period of time, and these are depicting the seasonal demand of current assets of the company. So when the season will start and it's on peak, we can borrow a short-term loan from a banking organization for 6 months, and when the season over, this inventory will be sold out so that we will be able at this time period to pay out our debt obligation since we have borrowed the money on time period 1 and paid out our this seasonal short-term financing at time 2 after 6 months. So such kind of financing is known as short-term financing to meet our seasonal requirement. And when the company approach is to meet out each asset with the same approximate maturity of that asset, that approach is known as hedging or maturity matching approach of financing the working capital. We can see this first point, that the less amount financed spontaneously by payable and accrual, because this has been financed with the help of long-term financing. And in addition to those spontaneous financing of payable and accruals, we have to contact with the depository institution for short-term financing as well to meet our seasonal requirements. So financing needs and the hedging approach. Let's conclude our discussion on the basis of graph that fixed assets of the company and as well as non-seasonal portion of current assets, what was available, are highlighted in with the help of red line of the current assets are financed with the long-term debt requirement or with the help of equity, because the long-term profitability of assets to cover the long-term financing cost of the firm. So this is the way our principle of hedging approach or the maturity matching approach. Secondly, we have also seen that seasonal needs, here are the seasonal needs of these jumps. When we are seeing increase in the level of current asset, this is known as the seasonal requirement. So the seasonal needs are financed with short-term loans because the season will get over the period of 3 months or 6 months, and then we will not be in need of that financing or loan. So the company will decide to return the principal along with its interest payment to the depository institution from where they have taken that loan amount. So under the normal operations, sufficient cash flow is expected to cover the short-term financing cost, and therefore the seasonal needs are financed with the help of short-term financing. Let's discuss the self-liquidating nature of short-term loans, because we are taking those loans for our seasonal requirement. Therefore, the seasonal orders require the purchase of inventory. Like in summer, if the business is a kind of soft drink and ice cream manufacturing, then it will require to increase its inventory in summer. And similarly, if the business nature is of clothes or apparel, so it will require the inventory increase in summer according to the summer collection, and similarly it will require to increase the winter collection if the winter season starts. So we need short-term loans in order to meet the seasonal orders of the customers. Secondly, we have increased the inventory is used to meet the increased demand of the final product in that particular season. Third, sales become receivable. When we sell out those inventory or finished product, it becomes our account receivable from those customers. Because usually in the business, 90% sales and purchases are done on credit basis. So when the company sell out that inventory, it will further allow the purchaser or consumer to pay out its obligation within 30 days or 15 days of time period. So for that specific time period, our sale become an account receivable and we have not collected cash yet. And the fourth step in seasonal business or seasonal requirement, our receivable due from clients or customers are collected and transformed into the cash or depository or treasury of the company. Now it's time to return the loan. The resulting cash funds which have been collected from our sales can be used to pay off the seasonal short-term loan, as we have borrowed our money at the very start to cover up the seasonal requirement. So therefore this seasonal requirement has been met and we have taken a self-liquidating short-term loan which itself has been liquidated within 3 or 6 months of time period. So after collecting that cash funds, we can use that funds to return the seasonal short-term loan along with covering the associated long-term financing cost or short-term interest rate as well. So this is the way how the current assets are managed in the company by taking the seasonal short-term loans. However, if the nature of current asset is of permanent in the company, then that kind of current assets are still financed with the help of long-term financing in order to meet the hedging or maturity matching. Dear students, after discussing the hedging and maturity principle, we can say the hedging approach for working capital management, let's move towards the second approach of financing our working capital management, which is a conservative approach. As the name itself is explaining that here the financial manager or the company is looking for a safe game or safe side. As far as the financing is concerned for the current assets, the company is going to finance the current level of assets along with certain part of seasonal demands with the long-term strategies. So under the conservative approach, what is the trade-off between risk and cost shall be discussed shortly. Let's look at the first narration that firm can reduce risk associated with short-term borrowing by using a larger portion of long-term financing. Now, what does it mean? If the company is aggressively borrowing the short-term loan, then there is an associated risk factor with such borrowing, because after the completion of each 1 year of time period when this borrowed loan maturity will over and the company is looking to pay out this loan back to the depository institution from where they have borrowed. So the next year interest rate might be different than what they have been charged for the previous year. Therefore, there is an associated risk factor if the company is continuously looking to borrow short term. So therefore, in order to overcome this future uncertainty, the conservative approach states that to borrow or to finance the larger portion of our assets with long-term financing. Now let's explain this conservative approach with the help of diagram. As we can see, the total dollar amounts of our assets on the y-axis, and on the horizontal axis there is time factor. This blue line is depicting the fixed assets in our company like land, building and equipment. These fixed assets do not change over the period of time in the company. So therefore, the fixed asset must be financed with long-term financing strategy. We can see this red line just above the fixed assets level, and this straight linear line is representing that we have fixed nature of current assets required in our company. And this fixed nature of current assets is, or it was previously just beneath these seasonal demands. However, the conservative approach is requiring us to shift this fixed nature of current assets well above the previous line to the second point. Let me explain. Now we are in a position and we can see that a larger portion of long-term financing is used not only to finance our fixed asset, but as well as the fixed nature of current assets that lost in our company for a number of time periods and for a number of years, irrespective of the seasonal demands. However, these jumps and drops is referring to the seasonal requirement of the inventory. We can see that there is a greater portion of long-term financing which is not only covering the fixed asset but as well as the fixed nature of current assets. Along with that, up to certain level, as we can see, the highlighted portion of our seasonal demands was also covered with the help of long-term financing. So here the company has borrowed the long-term financing, and in order to meet the certain level of seasonal requirements, like this season was starting from this point to up to this point. However, we can see that 25% of the seasonal requirement was met with the help of the long-term financing portion. So such kind of a strategy is known as the conservative approach by the company or the financial manager. Now, what are pros and cons of this strategy? Number first, what are the benefits of this conservative approach or long-term financing? The first benefit is that there is less worry in refinancing shorter obligations. Like the manager is free of worries to refinance the short-term loan for the subsequent year. Rather, we have the long-term financing in our company for 5 years or for 6 years, which lost and which is helpful for the company to meet its seasonal requirements. Along with that, the fixed nature of current assets. The second benefit is that we are less uncertainty regarding the future interest cost. The manager is less worried about the future interest cost because the long-term financing interest rate has already been fixed between the parties. What are the risks associated with this strategy? We are borrowing, number first, we are borrowing more than what is necessary for our company. Secondly, we are borrowing at a higher overall cost because the long-term financing is offered to the company by the depository institution at a higher interest rate in comparison to the short-term financing. As a result, the manager accepts less expected profit in exchange for taking less amount of risk. And as I have already explained in my business finance lecture under the chapter of the risk and return relationship, that when there is less amount of risk, then ultimately we are going to have less expected profit. And for taking the higher level of risk, there are more chances to have the higher level of profit. Now let's discuss the final approach of working capital management, which is named as an aggressive approach. As the name is explaining itself, that we are dealing, or rather the financial manager is looking to refinance the short-term financing strategy. That is, the firm increases the risk associated with the short-term borrowing by using the larger portion of short-term financing. So rather than to look for the long-term financing, under the aggressive approach, financial manager is looking to rely more on the short-term financing, and after the maturity, the manager will have to again refinance for the next subsequent year. So when the game is aggressive in the company for financing the working capital, in that case we are going to take a higher amount of risk. So therefore potential for the expected profit is also higher. Let's discuss this aggressive approach with the help of a diagram. As previously explained, the fixed level of the asset must be financed with the long-term financing. And we can see that previously our line was just beneath this, touching this seasonal requirement. This was our previous line for fixed nature of current assets. However, we can see that in this diagram, the company's financial manager is using the long-term financing portion to cover half of the fixed nature of current assets, and for the remaining amount of fixed nature of current assets, the financial manager is relying on the short-term financing, like they are borrowing again and again and a larger portion of short-term financing to cover the fixed nature of current asset, along with that the seasonal requirement. So what are pros and cons of this strategy? Let's discuss them one by one in detail. So we can clearly see from this diagram that long-term portion is covering half of the fixed nature of current assets. However, the remaining fixed nature of current asset is being covered or financed by the short-term financing strategy by the manager. So this type of strategy or approach is known as an aggressive approach for working capital management. The benefits for using this aggressive approach is that financing long-term needs with a lower interest cost, as the financial manager is borrowing money for the shorter period of time, so therefore the interest rate charged by the depository institution is quite lower in comparison to the long-term financing. Secondly, we are borrowing only what is necessary, so we are not going to borrow the extra or excessive amount of money from the depository institution. So therefore, we are going to pay less amount of interest against what we have borrowed as necessary. The shortfall or the risk factor associated with short-term financing is twofold. We are refinancing the short-term obligation in the future. That is more pain for the financial manager to refinance or to reschedule its loan for the subsequent year with the depository institution, which will require the time and effort by the financial manager. Secondly, there is a huge amount of uncertainty. We are uncertain about the future interest cost. What if the government has taken policy to increase the interest level in the economy by making the stringent monetary policy in order to control the inflation? If the interest rate may rise in the subsequent year, so the risk factor is that in the next year the financial manager is going to pay the higher amount of interest charge against the short-term loan. What we can conclude from this aggressive approach is manager is accepting the greater expected profit in exchange for taking the greater amount of risk. And what is the risk factor in this aggressive approach? The higher level of interest rate may be in the economy for the subsequent year if the government has changed its monetary policy to strengthen the money supply in the economy. So let's conclude our discussion of short-term versus long-term financing. Here we have financing maturity at the left hand side. Financing maturity may be either short-term, that is for less than 1 year of time period, or it may be long-term, which requires to pay out the debt obligation in more than 1 year of time period. Secondly, we have the asset maturity. Either we have a short-term assets requirement that will transform into the cash within 1 year of time period. Therefore, it is named as a temporary asset, or the nature of or maturity of the asset may be permanent, which means that it's a fixed asset, or even though if it is a current asset like cash, inventory or account receivable, it will all the time be available on the balance sheet of the company. Therefore, it is long-term in nature. So what this diagram is telling all about, let me explain. The working capital management is asking that if there is a short-term requirement which is temporary in nature, that kind of assets must be financed with the short-term loan if the company policy is to have a moderate risk and profitability nexus. If the company is going to have a conservative approach, that is not to take the higher amount of risk, they must finance their short-term temporary current asset with the short-term loan. Similarly, for the long-term nature of the asset, if the company is not interested to take the higher amount of risk, then the long-term nature of the asset must be financed with the long-term financing strategy. So therefore, this yellow rectangle is referring towards the acceptance of moderate risk and profitability by the financial manager. However, on the other side, if the asset's maturity is short-term in nature and temporary, and the company has opted, or financial manager has opted for long-term financing strategy, then it will turn out into low risk and low profitability. Secondly, if the asset's maturity is permanent in nature, that is, it is lasting for more than 1 year of time period in the company or continuously over the period of time, and the company policy is to refinance its loan with short-term financing, that is, they are playing the aggressive approach to finance for the working capital management. In that case, the company or the financial manager is accepting the higher level of risk and the higher expected profitability. So this is the conservative approach if the company is using long-term financing for short-term nature of asset, and if the company is using short-term financing for permanent nature of the asset to be financed, then the company is using the aggressive policy for working capital management. So this was all about the concept and approaches used by the managers in the legal form of business entity by using either the hedging approach or conservative approach, or being an aggressive for doing or for arranging the finances for working capital. Thank you very much for listening to this lecture. If you have any confusion or question related with working capital management, you are free to ask your question either on KCMS or another way around. You can also email me on my official email address with your queries as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.